Good morning, everybody. Welcome to the last flow show of 2023. Today's our last one, and then we will be back January the 3rd, if I'm not mistaken. That'll be when we return to full trading. So, yep, this is it for Christmas. Happy holidays to all of you. Thank you for coming. Morning, Kay. You all right, mate?
Yeah, good morning, Ryan. Good morning, everybody. Wishing you all an excellent festive season as well, and already a Merry Christmas. And yeah, I'm doing all right, mate. You too?
Yeah, not too bad, not too bad. All cooking along, as we say, watching dollar yen just go higher and higher and higher. Kicking myself from yesterday. It's always easy hindsight trading, but it seemed like a complete open goal buying dollar yen yesterday morning.
Yeah.
In the run up, but you know, you never know with these guys; they can pull something out of the hat. But we'll talk about the comments from the BOJ shortly. Right, let's get stuck into it. Over in China, the NDRC, which is the National Development and something Committee, can't remember the name, says it sees a mild rebound in CPI next year. You might recall they've had 2 months of negative inflation numbers, which got progressively larger. And so they see a rebound in CPI next year. If they don't, then we can expect them to step up the easing. I'll leave the BOJ to last so we can get right into it. The RBA board considered whether to raise by 25 pips or hold steady, according to their minutes. Nothing else really of note in those minutes, the same old guff. So nothing too much from that. BOE's Broadbent was out yesterday, say we will probably require more protracted and clearer decline in wage growth data before the MPC can safely conclude that things are on a firmly downward trend, talking about inflation, obviously. It says it's too soon to say that wage growth is cooling. The UK may need a longer period of below trend growth. So basic message there is he expects things to be shit next year. And until wages come down, they're not going to do anything much on rates, bar keeping them up. ECB's Casimir said it's premature. Says premature easing is worse than holding too long. So he's pushing back against the early cut mantra from the market. ECB Stornos, one of the, I'd say moderate to dovish. He was one of the ones calling for rates to be kept on hold and that we're at a peak, pretty much alongside some of the others. Said we need to see inflation sustainably below 3% by mid-year before cutting rates. So also a bit of a pushback on early rate cuts. ECB's Wunsch was out again, saying rates won't be lowered as fast as the markets are pricing. He says wages hold the key to interest rate cuts. ECB Simkus market rate cut expectations are too optimistic. So we've all got the message now. Thank you very much, boys and girls. You're saying the market is wrong predicting early cuts. Little bit of
Right.
yeah.
Yeah, they just wanted to repeat everything. So for us in the last flow show to be able to tell our audience that everything is very clear, you know. I think they did it on purpose, just for us to make everything sure, you know.
Yeah, just in case you didn't hear the first 30 times. And they'll no doubt we'll be hearing it for another 60 times until the next ECB meeting when they'll say it all over again. Small bit of data out yesterday. NHAB housing market index in the US came in up at 37 versus 34. I won't bother switching it to calendar because that's the only data out yesterday. Over to the Fed. Fed's Mester says markets are a bit ahead of central bank on rate cuts. Mester is a 3-cutter. She is in the median line of those expecting 3 cuts next year. However, whether she gets to see them or not is another question because she's retiring in June. So she'll be out the door potentially by the time they get their first cut. Fed's Goolsbee says there seems to be some confusion in markets to how the FOMC actually works. He said there was no contradiction between what Fed's Williams said and what Powell said over the past week. well, you can take your own interpretation of that. The market certainly did with its reaction between Powell and Williams. Fed's Daily says rate cuts could be needed next year to prevent over tightening. Says her outlook for rates was very close to the median. Considering she was largely on the hawkish side, maybe that's put her in a 2-cut camp rather than the 1-cut camp. But we shall see anyway. She becomes a voter next year as well. Bank of America Global Research, here we go already, now expects the Fed to deliver 4 25 pip cuts, so going one more than what the Fed expect. And we'll see, no doubt, give it a couple of months, they'll probably be predicting 6 rate cuts, such as the way markets are going. Now, Bank of Canada's Macklem decided that literally 5 minutes after saying they weren't discussing rate cuts, has come out to say that the central bank will probably cut rates sometime next year. Says he needs to see several months of sustained downward momentum in core inflation first. So he's tipping a nod as to what would signal a potential rate cut. Core inflation, not headline inflation. Says we are very focused on core inflation. The first part of 2024 is not going to feel good. Macklem, doing a bit of a flip-flop, Kay. I think it was literally Friday when he said they weren't talking about rate cuts.
Is he? He must be having something going wrong or feeling ill in the second part of this year, because he's been doing, well, 90 degrees or 180 a couple of times towards the year end. It just shows us that they don't know where they are at. And it's a very clumsy way of telling people that they are data dependent. But yeah, I mean, it's not helping. It's not helping the market actually to calm down in any way or shape. And you know what? I think it may. I don't know whether we are going to see it directly, but it may in the end perhaps hold people back from trading Canada if oil would rebound or so, because he's just putting more doubt in people's minds.
Yeah.
I don't like those kind of comments to be honest, but okay, we've had it already, and we have sorry, we have the Canadian CPI out this afternoon as well, which could, if it would come in a little bit weaker, have people remind what he said yesterday and send the Canada a fair bit lower, if all ifs,
Yeah.
of course. Yeah.
Yeah, there was. I saw it when that headline dropped last night, and there was zero move in the CAD on that. So yeah, we'll get to see whether, as you say, CPI later maybe does get a move for the loonie. Mexico Governor Ceja says that the bank should discuss an interest rate cut in Q1. That's already largely known. That they were scratching around that area for when they might start to cut. So just a bit of reaffirmation of that. It looks like we've got this risk, the Red Sea risk building up. You know, no one can give us a quiet Christmas. So this is what's going to be ramping up over there. BP yesterday said they're going to pause all oil tanker transits through the Red Sea. Other firms have followed as well. We told you that Maersk and Hapag-Lloyd also stopped transit through there. They are now taking the long detour around Africa to get through to the Med and Europe. US Defense Secretary Austin said, we are building a coalition to address the Houthi threat. And obviously the Houthis replied to that, saying that we will be able to confront any possible coalition that could be formed by the US in the Red Sea. They also issued a statement saying that any ships that are going about normal business won't be targeted, but only those that are stopping off or picking up from Israel are the ones that are going to be targeted. So it tells you what's going on there. Obviously, the Houthis and that area have heavy influences from Iran, Hezbollah, and all that stuff. So just to let you know what angle is being played there. But yeah, it looks like a task force is going to be built. The US said a task force of allies to protect ships in the area. So it means a stepping up of naval action there, which could lead to anything, as we well know. So that's our risk event going into the holidays. The Pentagon also warned that Ukraine military aid funds will run out 30th of December. Again, another possible risk headline to take into the end of the year. If the US stops funding Ukraine, they might come up short in armaments and the like, and give Putin a little bit of a boost, perhaps to step up his offensive, shall we say. Obviously, going into the winter, it makes everything a bit harder, but you know, Ukraine is relying a lot on aid from everywhere. Germany has reaffirmed its stance of doing whatever it takes to provide funds to the Ukraine to keep them going. So the slack might have to be picked up from others if the US funding stops. But again, another unfortunate risk headline to just keep a beady eye on. Right, over to the good old Bank of Japan. They left policy unchanged as expected, no changes to ICC or anything like that. Said that year-on-year CPI rise likely to be above 2% through the fiscal year 2024. Now, if you remember the rhetoric all this year, they expected inflation to pull back during the second half of the fiscal year before picking up again later. So they're reaffirming that stance, and that inflation will be above their target through the next financial year. It says underlying CPI likely to gradually rise. The Ministry of Finance cut confirmed that they're bringing forward their cut to 20-year bond sales. They're going to only go 1 trillion yen down from 1.2 trillion yen. This is mainly due because there's a lessening of appetite for longer term bonds that are yielding low rates when, as a lot of people expect, rates are going to start rising. So they're going to probably do a little bit of switching around on what they do with the auctions and durations, particularly depending on appetite, just part and parcel of the shifting interest rate landscape. Right, over to Ueda. He started off with the old set of comments. You know, still ready to continue easing, doesn't see any real change to things at the moment, the usual stuff. But he did take another pigeon steps, I'm going to call it, towards what we all know is coming. So he said he's seeing positive comments on wages next year. Still need to gauge whether prices will rise ahead. The chances for hitting 2% target are rising. It's important to confirm whether wages and prices are in a virtuous cycle. Wants to see wage gains spread to prices and service prices, but won't rely on a single data set for policy direction. Then he said, well, generally speaking, a policy change could involve an element of surprise, but it should be possible for the market to forecast our policy shift at least to some extent. He said that it's still hard to show exit plans with certainty now. Then said accommodative conditions would be maintained for an unspecified period of time after the lifting of negative rates. Then we did get a bit of a funky comment. This was reported by Bloomberg, who said that Ueda said that there's no talk on the board about avoiding normalisation in March, which to anyone who follows the BOJ, like myself and the K-Man and plenty of others, that pretty much says they're going to normalise in March. You know, not talking about avoiding normalising in March. But that was a headline from one of the wires, you know who like to spin things up. And it actually came from a comment that said, no discussion now on taking into account the impact on companies' full year earnings ending in March in the timing of any policy change. So that doesn't sound like they're going to start normalising in March. But it's just another example of how Newswires can spin headlines to make it sound like something else to try and get a reaction in the market. Fortunately, this time traders didn't buy into that or listen to that headline, really read through it. But yeah, that could have caused a bit of panic in the market. So, okay, as I said, pigeon steps in this meeting. He did also say that there's nothing due to happen in the next meeting, which is in January. So he's definitely kicking a can to the spring, which we all know anyway. But yeah, just little words and comments that just keep us on the path, shall we say?
Yeah. So there's a couple of things there. First of all, it's really exactly as we expected, right? I mean, keeping everything in place and starting to and continue to change the wording to continue to prepare the market or the public, the government included, to say that they will normalize at some stage. But again, it is a standstill where we are now. It's really a standstill, and the markets, I think, rightfully have taken it that way. You see the Nikkei is higher, the JGB yields are actually coming off. So there's absolutely nothing there which tells us that they are ready or they are going to surprise us to in between meetings, to do something. So it's exactly as planned. I'm not going to say that I'm overly surprised, but I'm not surprised by the move, but I'm somewhere just a little surprised by the amplitude of the move. We've done sorry, 250 points here, nearly, right? And for something that I thought would have been rightly expected, I'm a little I am just that surprised that the move is that big, because it does seem that the market in a way was expecting something. Now that brings me back to where we were, call it a month ago. It's still the same old theme. Unless the rest of the world falls apart around Japan, it's still going to be very tough to be long yen for a lasting period. And I'm not even talking about levels or should we sell at 145 or should we sell at 148 or should we buy at 144? And we don't know. But the thing is, it brings me back at least to I can't be long yen for a longer period. And because it may have been a different issue if those JGB yields were closer to 1%, because that would have kept, since the rest of the yields are heavy in the US, in the EU, everywhere around it, in the majors, that would have been a little bit easier to trade the yen from the long side. But those JGBs coming back down, and with the Nikkei responding positively to what happened, I'm just looking at it. It rose like 1.3% in Tokyo, and all in all, we are now nearly 2%, 2.5% up in the futures. It's just a bit too much for the yen to take, I think. And whether it's the people getting out of positions that they were hoping for something, I don't know. But to me, it's not. Again, I'm going to have to fall back on data which happened outside of Japan for another month and a half, and because Ueda is saying there may be an element of surprise, but at the same time he says we could continue with the YCC or an easing in place even after we start to normalize rates. I mean, that is a pretty dovish message somewhere, right?
Yeah, very much so, mate. Very much so. But yeah, it's all the waiting game, isn't it?
Yeah, and the rest is really, you have to understand these split tone talks that Japanese officials, Bank of Japan or others are really still using, especially the old guard. They give something, they take it back on the other side.
Yeah.
I thought I actually misread that Japanese government 20-year bond issuance. They actually, I thought they were bringing forward the issuance, but there's also They only bring forward like some 200 billion yen, which is absolutely nothing compared to all their stimulus packages. So they seem to still be actually a bit relaxed about the whole situation, and not wanting to bring forward JGB bond issuances, which I thought would be a logic evolution in their plans, especially now that JGB yields are still very reasonable. But no, apparently they are still not very nervous. Now, the last thing, and then I give it back to you. The last thing is there's one line that resonates in my mind, in my brain, and that's what Kuroda said last year during the interventions, that he thinks that 200-300 points per day are excessive. If you look at the low of the day, but that was pre-Bank of Japan. Okay, the low of the day is around 142.25. We went into the Bank of Japan. If I took the charts back and the timing back, around 142.60, if I'm not mistaken. Is it that where we were around before it started to shoot? 2.5,
around
yeah,
there.
roughly.
Yeah.
So if you take those, let's say the upper side, the 300 points into consideration, perhaps we should be a bit careful if we go up above 45.25 or up to 45.60, perhaps to trigger some Suzuki or MOF comments. But I don't think, looking at the level as such of the dollar yen, that we are close to interventions. But okay, something that we just need to bear in the back of our mind.
Yeah, I think they can't really come out and moan about the move. You know, they've Ueda was part of the reason that caused the move down in the first place. So him, dialing back a bit on those comments as well is no surprise to see it rallying. So this is of their own making, really. So they can't really complain about what the market's doing with it. But we'll see. They were still commenting when it was coming down. A couple of them said they're still watching FX markets and volatility and the like. I don't know what this spike down was. Some sort of headline. I don't know if perhaps it was an early read on that Bloomberg headline. But yeah, as we can see, I'm surprised it's gone this high. I am and I'm not. I thought it might be going up yesterday, but I'm surprised it's gone up here. We are getting into a big old zone here. The old zone, it goes back quite some time as well. If you go in the long-term charts, 145. So no surprise we're going to see it banging its head in this zone. Perhaps if it carries on through that, then I don't know where it could be going. Could be all going all the way up to 146, 147. Maybe some year-end stuff in the mix in that as well. I'm still short a tiny bit from the other day. I've gone a little bit short here at 144.93. Some to put in the long-term pot, and I'm just going to play a big figure trade for a quick scalp off this one as well. See if we get a little bit of a pullback if this level holds. But yeah, I finally scratched the itch getting in some shorts. Carry be damned. I need to be in something, and yeah, I'll see if what happens in the new year, whether the expectation starts to ramp up coming into the early part of the new year. But I'll be pretty dynamic with it still. If I get some decent profit on the longer term bits, I'll be slicing and dicing to build up ammo against the carry at least. So that's what I'm looking at there. It's another bit of a washing machine. Euro, dollars holding up. I don't know if this is maybe a bit of influence. We're being dragged up by the yen crosses, which are all running higher. So that might be what's pulling up the majors for once. The majors are following the crosses because dollar's strong in dollar yen, but we're also seeing cable euro dollar strong. So that suggests it's not a dollar move; it's something else. Euro sterling, it was looking pretty, knocking up again, but again the speed of euro dollar versus cable looks to be playing out in this one again. Cable going much higher than the euro, so that's putting some pressure on here. Back down here, I thought we might be back off to the races again, getting up, but bang into the zone yesterday, the bottom of my zone. Let's put it on a bit of a wider chart.
I think there's been a bit of West things in there in some of those pairs.
A bit of what, sorry?
Suez things in there, Suez issues in there in some of those pairs.
Yeah.
Because yesterday afternoon, when the main headlines started to roll in, we saw a bit of action in some of those pairs. Those who are perhaps a little bit more involved, and those who may suffer a bit more from issues in the Suez Canal, because it's like a big transit zone for goods across the globe. And I've got the impression that, and I'm also looking at stuff like yesterday on the Aussie, on sterling perhaps as well, in a way, if UK got a bit vocal about it as well, and I'm also putting it down to a bit of already end of year liquidity perhaps, and we see some of those moves have been undone this morning, and I think that's about it. When those shipment companies are finding other ways of putting their goods to their clients, I think that has also helped this morning with reversing some of those yesterday afternoon moves. So yeah, there were a few funky moves in some of the crosses, and perhaps the sterling it was one of those.
Yeah.
I don't know exactly how much of the of UK goods are transiting the canal, but also UK was pretty vocal on getting involved in that task force and things, and perhaps just a few market participants got a little bit nervous about everything and decided to go out of, or to buy some insurance against possible worsening of the situation.
Yeah, very much so. And that's been the main thing. The big insurance companies for all these shippers obviously going onto war clauses, as whatever they call it. So yeah, costs are going up for shippers. They're having to detour a hell of a long way to get around it. So yeah, it's going to probably have, if it lasts, it's probably going to have a little bit of an economic effect at some point. And obviously potential price pressures, inflationary pressures coming into that, but we may not see that for a couple of months or whatever. But yeah, not a good situation to go into the holidays with. Aussie dollar, and then I'll just have a quick one. Well, what I'll do is I'll look at the calendar as well, because we wanted to look at that. That's back up towards the highs again. Can we get a little bit of a break here? Pulled up around this 67.30 area. A bit of an on-off up here, 67.40s, bit of an on-off level. Not too much of a hot one, but an old one I've had on my chart, and that's where we're sitting just below at the moment. So a break above there might give us a little bit of a nudge up to the highs and 68s, or high 67s into 68s. A bit of a push up, but again, a lot of this is feeling like it's yen led, rather than because anything's going super duper in Aussie land. This one might be interesting. We've had a double top form up here. This might be a decent stretch point if we get up there. So that's one to look at. But otherwise, again, I'm not doing an awful lot. Just got the sniper rifle out, as I just said, in dollar yen. But as for the rest, I don't want to be caught up in the washing machine in the last few trading days before the holidays. Let's have a quick look at the calendar, because I missed this yesterday, and we have got a few bits, and I'll hand it over to the K-Meister. We had Eurozone HICP, which was unchanged, so confirming that 2.4% number in the headline and 3.6 in the core. No change there. We get some housing starts and building permits from the US today. Then that CAD CPI, which, as Kay mentioned, could be a little bit funky for the loonie on the back of what Macklem has just said. UK CPI first thing tomorrow morning. You won't catch me up for that one. I still refuse, and I'm going to refuse into 2024 to get up for 7 a.m. data in the UK. They can bloody well put it back to 9:30 in the morning where it used to be.
Come on, mate.
No,
where's your professionalism, your dedication to the cause?
I'm on strike. What? They moved. I think they moved it because of COVID, to 7 o'clock. Don't ask me why, and they just haven't moved it back. So yeah, I'm on strike, and I'm going to stay on strike. They can put it back to
I mean,
9:30.
they just did it to annoy us. That's pure.
Exactly. Who wants to get up for numbers that are probably wrong anyway? Anyway, right, enough moaning. It's Christmas. Got to be happy and go lucky about things. Get some inflation data from Germany as well, and then PPI. It's all the same part of that same report. US consumer confidence on Wednesday could be a reasonably decent number to look out for. This is the conference board number, not the Michigan number. So we'll be looking for what's happening with the consumer and those inflation expectations, which pulled back quite somewhat in the last reports. More housing data from the US, and then that rubbish consumer confidence flash number for the Eurozone. Final GDP on Thursday from the US, so that'll be old news by then, unless there's a really huge change in the number. But we've had 18 readings of that so far, so no one's going to be bothered. Canada retail sales might be something for the Looney to get hold of. We've already seen the Empire and the PMIs coming in, so Philly Fed manufacturing is just going to add to that. Friday retail sales, if anyone's still about, again, you won't catch me in for that one, but this is for the November numbers. So I think it's for the November numbers. I better check before I talk at me backside. Where was it? Yeah, for November. So expected to come in up 0.6%. I'm expecting a positive one. Whether it beats that 0.6% is another matter, but just keep that in mind. If you're glutton for punishment and you're still trading on Friday, keep an eye on that number. It might be hotter than expected, just based on my anecdotal evidence from from November, being out and about on the streets. So yeah, I've lost it. If you're out and about trading that one, just keep an eye on that. Load more numbers in the afternoon, but again, they're probably going to get ignored. A lot of the market's going to be clearing off on Friday. So yeah, be careful getting stuck into, if you're trading data, just be careful with these if you trade that, because you could be trading a dead market and then stuck in something that's not going to move anywhere for the rest of the day. I know there's not going to be some shows, I think, from the guys, the rest of the ForexAnalytix guys. Well, Blake, I know Blake's off
On Friday.
Well, he's potentially off at some point because he's travelling. So I'm not sure what's happening in its entirety Friday with the shows, the rest of the shows. But Steve apparently is going to do every single show from now until the new year. So
Even in the weekends.
Even at the weekends, he's going to get up 6 o'clock on the weekend to give you a show. And Christmas Day, forget Santa, you can wake up with Steve. What a thought that is. I know. I hope he's not listening. He's there on the panel.
Of course he's listening. He will hear you. Hey Steve, I haven't said that. Okay, I can stay on the team. All right, I haven't said that. I love Greeks. For as long as you give me the Greek crisis money back to the Europeans.
Yeah, but you're not getting your marbles back from us. Anyway, right, Kate, go on, take it away, mate.
Yeah, right. Just one thing on these numbers. You were showing the on Friday. I do think we've got some PCE prices and stuff there.
Oh yeah, PCE, yeah.
Yeah. So that could be a late week mover, especially that people are not going to be trading much, but probably algos are going to be a bit more. How shall I say? The bank algos, the liquidity providers, are probably going to have screwed back on liquidity already by then. So if anyone or if any of the clients or whatever want to do something, it might actually take stuff away a bit more from actual prices than what it usually would. So I would say, especially on Friday, folks, be very, very cautious with what you have in your books.
Yeah, definitely. Good advice, mate. Right, go on. Let's see you pick some gems.
Yesterday I said I was going to look at some of the yen pairs, right, after the Bank of Japan. So That's what we are going to do today. First of all, the dollar yen. And let me just first go back onto a bit of a wider one. Here. Because if you look at what we've been trading, I'm not going to go back to 2021, although it's still perhaps a bit useful, because if you look at the whole move from when we started to go back up. If you look at that, 23.6 is still only at 140 and a quarter, and whatever that been happening in ahead of the Bank of Japan and on those US yields and European yields crapping the bed, we are still above that level. So this is one of those levels that I am keeping a bit of an eye on. It also somewhere roughly coincides with the 38 point, no, here. Yeah, well, that's a bit lower, but there's also there's a bit of stuff going on around 140. Anyway, we started around the 200 DMA, and yesterday I already said 200 DMA. This may be one that people are looking at. The daily cloud is too high. Well, I guess it's too high right now. That only comes in well above 148. I doubt that we are going to get there, all unless this market goes bananas the other way around. But what what I was looking at is this 144.60, 145 zone in the dollar yen, because it is still the 50%, and we have seen activity every time in this 144.60, 145 zone. We've seen activity, and even on a shorter time frame, we have seen activity in this zone all the time. So that means that the market has been trading actively around this 144.60, 145. Also, have a look here. This is the FOMC move, which is now virtually undone. All right, we are about 20 points away from undoing the FOMC move. So it's also a bit of a trend line here, coming down from the highs. This is a bit of a too rough trend line for me, because it cuts a few spikes, but yet it does look a little it does look quite all right, and it's also coming in this zone. So we are in this 50 points zone here, where I think it may be important enough to see where we are the further we go throughout the day, whether this can make a move through or not, in which case, if it would move through, your next levels will be around 146.30, 60. That for the dollar yen, but again, I mean, I'm back in my scenario where I think it's going to be hard to stay long yen for longer, unless, of course, you're right, and the rest of the world is falling apart around it, and but that may have to wait for 2024, right? And I'm not ready to really pay up for this kind of carry or funding right now. So looking at those yen crosses, I was saying yesterday on F.A.C.E, I say this channel here, I'm going to have a close look at what's happening here, and it came in, the trend line came in around this prior high and came in around this prior low, and I thought, like, okay, this is perhaps a good enough zone to maybe think about even a counter trade. But then looking at how the euro performs, looking at how that dollar yen really shot up, I kept away from it. It's again, I mean, this Bank of Japan meeting is not giving me personally enough food to buy yen. I'm ready to do so if it's really warranted. But this Bank of Japan meeting is not giving it to me, really not. So now we are here on the next bit of horizontal resistance already in the euro yen around 158, 50, 60, call it, and levels above, and I wouldn't. If the end of the year is panning out like my kind of base view is, and that is risk is going to do okay-ish. That's not going to help the yen either. So it may be that we grind up into somewhere closer to 160 to close the year. Now, the party may be over if we get back below 157.6580. Keep this 6580, call it 157.6580, you know, oh, 85. So this is where we have to watch what's happening if we start to get setbacks in the euro yen. All right. Now moving over to those commodity yen. You know that the commodity currencies have been relatively buoyant. We had this how shall I say, this Aussie dollar that we showed the other day around 65 and a quarter, which held up really well. And look where we are. We are back at those big zones that we had. Okay, we still have a double top here, around 98.55, 60 on the Aussie yen, and this is a weekly, by the way, okay? But I just wanted to show you this trend line that we had. We had a false break above, then we had a sharp move down again, but we are back on it. It's around 97.70. It's around this prior high as well. If this starts to go at some stage during this week, we may have a retest of the 98.50, 60 zone, okay? In the shorter term, we really will have to start to break back under 96.80 here, okay? 96.80, okay, this trend line is I find it a bit fragile. I'm actually going to take it out. I don't like it. But 96.80 is where you are going to be watching what's going to happen on the downside. And if we get a confirmation through 96.45, this could spell trouble and something perhaps happening. Again, everything I'm showing here is all in the assumption that it's a natural move. I mean, if we get interventions, all bets are off, of course, because then it's only what the MOF decides to do with it that is going to be determining for what the markets are doing, and you of course are going to get sharp drops. Kiwi yen ditto, you know, we had this really very long-term trend line which been tried, broken, failed, broken above. This was a bit of a more thorough move, but this one here, which was the underside of a possible triangle, is actually holding relatively well, and we are already back to the top side of it, okay? So this is to show you how all those yen pairs are evolving and what's happening after this meeting of the Bank of Japan. We've also spoke about in the room. I think Gav had a different picture here showing some 182.5 or so. But if you look at the longer term here, we've also been holding levels, and now we are starting to make a move back into traffic zones where we were before. This is sterling yen, okay? Look at these highs, lows, high lows. It's all happening in this 183.5, 183, 184 zone. And this is just to show you how this yen evolves and how the Bank of Japan has now influenced this and where we are. We are back on levels where we are not back at tops because the rest of the world yields have been coming off very sharply. But we are getting back to those levels that we viewed in the past as very positive still, and the move is not done. We are going to push, and we are back at those kind of levels, okay? So that's, I'm just saying, like, we are levels at where we can stabilize, as I showed you on the dollar yen, on the euro yen, on whatever, the Aussie and Kiwi yen. We are levels where we can stabilize, but we are back at levels where it's dangerous to need an extra move onto it, you know. So I'm going to be a bit cautious where we are now. I'm not initiating anything. I had just a short-term stab earlier because I was a bit frustrated not to have been up for the Bank of Japan and caught this move higher. But I'm not taking any decent positions here, but I'm going to have to see breaks back down, really breaks back down to tell me that the yen can strengthen. Okay, I think, is it around here? Yeah, that 182.5, I think, was what Gav showed in our room. Yeah, okay, that's the study, but I think there's something at 182.5. Yeah, that's still that 50% of that last move higher. You see, this is also a zone. It really has to get back below there to have a chance to get back to 180. Okay, these moves are all looking quite impulsive to me. All right, that for the yen pairs. I wanted to show something in yeah, first of all, Aussie dollar. That looks like it's starting to flag a bit here, which may keep it quite supported. I think the next support after having bounced off the 65.25 now is going to come in around 66, 60, 67.5. This trend line looks to be traversed a bit too often for my liking. I'm going to take this out. I don't like it. But there was something on a longer time frame which is coming in. This one here has been broken, and that comes in at around 66.5. But it has been tested, failed, tested, failed, tested, failed, and we are above it. So I think this could be one that is to monitor going into year end. And again, my assumption is right in a way that risk would be doing better. If you look at commodities, they like when risk is doing well. Okay, I'm just saying I'm a little long Aussie, but it's against the euro because I think this one has now shown that above in this 164s it was heavy, and we have those spikes. And yesterday afternoon spike, is one that I think had to do with this Suez stuff. Okay, there can be take profit buyers around here, but I think this is because we were saying like some currencies may suffer a bit because they are exporters, and they rely a lot on exports. And I think that was the nervosity that we saw yesterday afternoon. Okay, but it's coming back down because the market is also, as we know, tends to forget. But if the insurers or if the shipping, that's the word I was looking for. If the shipping companies find ways around, like Maersk is trying to do, and TSMC, that nervosity can wane pretty quickly. And look, we could argue that this is in a bit of a temporary range or megaphone or whatever you want to call it, but it still looks to me that, and again, this is based on my risk assumption somewhere, that we could see, no, this is Euro Kiwi actually that I'm showing, but the Euro Aussie looks pretty much the same. And I actually I was a bit surprised by my own stuff. So this one here is the nervosity about the Suez Canal, in my opinion. But we are coming back to this thing, and yeah, that's where exactly I was looking for, sorry. So this 162.30 zone Euro Aussie is where it holds or folds, in my opinion. And if my hunch about risk is correct, I do think that this could be in for this final move of the year. Okay, this is just something that I'm trying to defend. I'm trying to trade it. For the shorter term, I'm already looking at what's going to happen on bounces between 163.10 and 163.30, and this is where we stopped yesterday. That's why I went out at some stage and then went back in, because it stopped right here. Okay, so this is one that I'm particularly looking at, and another one that I'm looking at. And if you look at what's happened in November here in euro sterling, you can You can do cable, you can do euro sterling, you can do whatever you want. But if you're unsure about the dollar, a cross is always a pretty decent alternative. If you look at what happened here in sterling, sterling was very bid at the end of November, okay, until the day before last. Versus the dollar, that is. But even in versus the euro, it was very bid as well. And that has to do with rebalancing of equity moves and partially bond moves, but especially equity moves. And if I look at the FTSE, and there I'm going to stick my neck out a little bit, I think we could actually see a remake of November. All right, that is providing those tomorrow and Friday data don't completely mess up the sterling picture. I'm going to be watching those very, very closely. But if they don't show anything really, really bad, I think we may just reproduce at least a small part of this move. Perhaps not the whole move, because 85 is going to be much too important, but at least partially this move. That providing that coming out of the data, we are below this 86, roughly 50-60 zone. All right. I think I've said enough, Ryan, unless people want me to look at something in particular before we close shop.
Well, just looking at the clock, I think
We're doing good, right?
Yeah, good enough, mate, as always. Yeah, once again, thank you all for supporting us during the Flow Show this year. It's been fun doing it. It's been great engaging with all you boys and girls in the chat. Keep it up next year. I want to hear more from you. Don't just leave it to us to waffle on. Let's get your conversations going as well. Thanks as ever to K-Man for all his wonderful work alongside me this year, and all the ForexAnalytix team as well, who keep this show on the road. So have a great Christmas. Have a happy new year. We'll obviously be around in the chat room on and off. And yeah, have a good one, folks. Have a nice break. Come back nice and refreshed. And
Ryan,
we'll see you all 2024. Yes, mate.
Yeah, thank you very much, mate. And I must say, you've been running this show like a master through the years. So thanks to you as well. Thanks, everybody. Merry Christmas. I guess we'll be around on some of the F.A.C.E shows as well. So that is not going to change too much. At least I will be on at least a fair percentage of them. So thanks, everybody. Merry Christmas already. Have a wonderful festive season. And we'll talk to each other in 2024. Thanks, Ryan. Thanks very much, man.
Thanks, mate. Cheers.